All right. That way, when I bring it all up, you don't have to click on the whole hour. You can pick what you want to watch. All right. So I want to talk about chapter 4. My thought is, can you guys send me a chat saying whether you have watched the videos of chapter 4? There's no shame in it. Okay. Well, you know, I should have done a poll. That would be really anonymous. But tell me if you've started chapter 4 videos, please. I'll just run through them. Just say yes or no in the chat if you've okay. Okay, so thank you everybody. So chapter 4 and chapter 5, we have like 2 weeks to get through. So our first week was last week. And if you had been in my daytime class, we would have already started the videos. And we are going to, your chapter 4 homework is due on Friday. And then your chapter 5 homework is due next Wednesday, part 1, and then part 2, chapter 5 next Friday. And then the exam will be November 17th. So it moves a little faster. So please watch my videos. What I wanted to do was just do some drill on chapter 4. I'm not sure you guys are going to be ready for this drill though. So I think I will bag this. And we can do some of this another time. So let me pull up something else here. Okay. Okay. All right. Oh, I don't want that. Let's go here. All right, so for next week, chapter 5 on Tuesday, we're going to do chapter 5 practice problems. So I would love it if you would finish chapter 4 this week, and then before next Tuesday, if you could look at chapter 5. All right. So would you guys tell me what you guys want to do for the rest of this? We've got another 20 minutes. What would you like to do for the rest? Would you like a quick overview of chapter 4? Or would you prefer drill? So say, put in the chat overview or drill, whichever one you want. Thank you, thank you. Thanks, Jacob, thanks, Dayun. Okay, I've only heard from 2 of you, so anyone else? Either would be helpful. Thank you, Tara. All right, so you guys have done 13 journal entries, okay? And I tested you on 13 journal entries. Now we're going into chapter 4, and we have something called adjusting journal entries and closing journal entries. Okay, so what I want you to do is I want you to really know what are the 4 prepaid journal entries and what are the 3 accrual journal entries. All right. So a prepaid means there was an original entry. We had one. We don't have it now. Now we're doing an adjustment, but in the past, we bought something and now we're using it up. Okay. Accruals you have already done, actually. We're just expanding on them. Okay. And the accrual example of the accrual is, oh, look, we made a sale to the customer, but we haven't billed them yet, but we get credit for it. Debit accounts receivable, credit service revenue. So we're going to go to three very specific accrual examples. One, the one I just said, if there's a sale we need to record. Two, an accrual for things like interest expense. And three, salaries. Okay, so let's just take a look. We do this because we have to do adjustments because we publish financial statements once a month or once a quarter or once a year. And the question is, we have to recognize all the revenue that occurred in that time period, for example, that month. If we don't, we're misstating financials. We're misstating our income statement. And of course, if we recognize revenue, if we record the sales transactions, we also have to record the expenses. Okay, so we have a fiscal year and a calendar year. And so companies get to pick their fiscal years. So a fiscal year could end December 31st, which would be the same, or they could change it to January 31st. If they end January 31st, that means the first day of their fiscal year is not January 1st, it would be February 1st. So a year is still 12 months. It just depends on how they do it. So financial statements are with the fiscal year. Okay. So accrual-based accounting, which is all of this, says we record transactions in the period that the events occur, regardless of whether we got cash or not. All right. So this recognizing revenue and expenses are two big concepts in accounting. One is called the revenue recognition principle. When can you recognize revenue? When can't you recognize revenue? And the matching principle, which is related to expenses. We have to do both. Okay. Companies recognize revenue when it was earned, when the service was performed. Okay, so cash could be received at the same time, but if it's not, then we'd book the entry anyway, but we wouldn't say debit to cash, we'd say debit to accounts receivable. But something else came up in chapter 3, which is you could get cash before the revenue is allowed to be recognized when a customer prepays. And in that case, we debit cash, but we don't debit or credit service revenue, we credit unearned revenue. Okay. All right. And expense recognition, also called matching principle. Okay. I'm going to skip this. So we have to do adjusting journal entries. We have to do them every single period. We look at our trial balance and we say, which of these accounts do we need to adjust? And then we also might say, are there any activities that have occurred that we need to book a journal entry, such as a sales transaction, or did we incur an expense that we need to recognize? So I want to emphasize that these are just seven journal entries, all right? But they're examples, and there's examples of these. These 7 are examples, and there might be variations, but they are the basic 7, okay? Each of these 7 journal entries is going to affect one balance sheet account, and that is either an asset or a liability account, not stockholders' equity, and one income statement account, revenue or expense. Each journal entry, each of these 7, and you will never, never see cash in these adjusting journal entries. If you put cash in there, you will be wrong. Okay, so here's an example. A company buys supplies for $900 on October 3rd, but at the end of the month, they count the supplies and they only have $250 worth of supplies. How much did they use? Put it in the chat. How much supplies did they use? They originally bought $900 worth at the beginning of the month, but at the end of the month, they only have $250 in supplies. How much did they use up? Tara, correct. Anybody else? Jacob, correct. Okay. So started with 900. Now you would have debited supplies 900 and credited cash up here on October 3rd. Dayun, correct. But now you only have 250. Okay. All right, so prepaids, also called deferrals, a total of 3 prepaid expenses, 1 unearned revenue. That's a total of 4 journal entries. Accrued revenue, it's 1, accrued expenses, 2, basic 7 entries. And like I said, there'll be variations. Okay. All right, so here's a trial balance. And I've highlighted 4 accounts that need to be adjusted. And these are examples of prepaids. Okay. Supplies, says advertising supplies, but you can just use supplies. Prepaid rent. Now, you could have had prepaid insurance, and that would also need to be adjusted. But the same process applies to both. So I'm only going to demonstrate one. Equipment. We bought a piece of equipment. The company bought a piece of equipment, and now we want to recognize that we're using it. And then unearned revenue for 900. Okay, let's take them one by one. So going back to that supplies account, beginning of the month, Emerald City graphic designers purchased supplies costing $15.50, and they debited the asset supplies. No other transactions have occurred. At the end of the month, they only have 800. So how much supplies did they use? Go. Okay. So if you look at the supplies T account here, we had $15.50 in it, but we need the ending balance to be $800. Okay. So the adjusting entry is to reduce the supplies account. Supplies are an asset. We reduce it by crediting it. And we're going to debit supplies expense to show that we used it up. We consumed those supplies. Okay. So now our asset account is properly stated. If we did not do this journal entry, our assets would be overstated at $15.50. And our expenses wouldn't reflect that additional $750. Okay. Okay, here's one. On January 2nd, Emerald City rents an office. These, oh, by the way, we did that transaction in the Chapter 3 PowerPoints, that supplies one and this one. This is a continuation of that problem. Okay. They paid 4 months rent in advance. Now it's the end of the month and the prepaid rent account still shows $4,400. But we've actually been in the building, the company's been in the building for a month. So now we've got to recognize that cost. So again, we reduce the asset by 1 month's rent and debit rent expense. Okay. So now prepaid rent only has $3,300 in it, and that represents the remaining 3 months of the rent. They prepaid 4 months, 1 month is gone. They've got 3 months left. Okay, now we're going to talk about the equipment. So you buy a piece of equipment. If it has a useful life of more than a year, you put it into under property, plant, and equipment. And now we have to, you've probably heard this term, we have to write it off. Okay, so we bought it for $5,600 and we're estimating that we're using this asset up over its 5-year life. I didn't give you that information, but I'm telling you now that it will depreciate $85 a month. Okay, so the journal entry here, now this is different. We don't credit the equipment account. We credit accumulated depreciation, okay? And we debit depreciation expense. So accumulated depreciation is where we track how much we've written off an asset. And that's why it's on the balance sheet under assets. It's a contra asset. Okay. So when we see this account on the statement, and this is what you guys put on your balance sheet, you'll see equipment on the balance sheet and then accumulated depreciation. So let's say you guys are sitting on an airplane in a month going somewhere, and the flight attendant comes out and tells you all about seat belts and oxygen masks, and you're already in the air. And what if he says, oh, by the way, this is a Boeing 737. Its original cost was $140 million. And the balance in accumulated depreciation is $139 million. Okay. That would tell you that that airplane's mostly written off. May not give you a sense of confidence, but it would tell you that. Okay. All right. So the last one is unearned revenue. Again, this was a journal entry we did in chapter 3 PowerPoints. And that's when a company prepays. Let's see. All right. So on January 15th, Emerald City received an advance for design work to be done by the end of the month. They didn't get it all done, but they've done about $650 worth of the design work. Okay. So we're going to recognize that revenue. So we're going to reduce unearned revenue. Unearned revenue is a liability, so it normally has a credit balance. Going to reduce unearned revenue by $650 and recognize service revenue. And these other journal entries are from chapter 3. Okay, so $650. Okay, so we get credit for that $650 revenue. All right. All right. Okay, those are the prepaids. I've got about 5 minutes, and then the accruals, there's no original journal entry. Okay. So the first one's accrued revenue. And the hardest part about accrued revenue, and it gets into a lot of fraud in practice, is are you allowed to call it a sale? You know the journal entry already. The journal entry is simple. You just debit accounts receivable, credit service revenue. And your homework problems or your test problems will say, Company X earned a certain amount of money for X, for doing whatever, doing service, hasn't been recorded or billed, something like that. And then you know the journal entry, you've been doing it since chapter 3, debit accounts receivable, credit service revenue. Again, we know that cash isn't involved in this one. Okay. There's no original journal entry in the 3 accrual entries. All right, so we've got 2 more accrual entries. And they're both expenses that are pretty common. One is salary. So those of you that have full-time jobs, when are you paid? Are you paid twice every other Friday? Are you paid once a month? Throw it twice a month. Yes, I love that system. Tara, are you paid every other Friday, or are you paid like on the 10th and the 25th? The 5th and the 20th, the 15th and the 31st. Okay. My favorite jobs, every job I've had forever, except working at Bellevue College, I was paid every other Friday. That's my favorite. At Bellevue College, I think I'm paid on the 10th and the 25th. But it's never quite that because it depends on where the Saturday falls and the day of the week. Okay, so remember, Emerald City is going to want to publish financial statements as of January 31st. But to make this super simple, we say they only pay once a month. And in January, they paid on the 29th. And in February, they're going to pay on the 26th. And that's that. But as of January 31st, and they paid for work up to the 29th. We're going to make it really simple. So as of the 31st, their employees will have worked 2 days. They've earned it. And the company owes them for 2 days of pay. So we have to accrue this. Now, getting the dollar amount sometimes is a little bit tricky. But the important thing is the journal entry is pretty straightforward. It's an accrual, so no cash is involved. It's going to be debit, salary and wages expense, credit, salary and wages payable. So then you have to figure out how much do we get. So this is for one person. He gets $3,600 every 4 weeks for a 5-day work week. So just divide 3,600 divide by 20, and he gets $180 a day, but it's 2 days, so it's 360. So that's the journal entry for salaries. Okay. And I would play it safe just in case. I would say salary and wages expense and salary and wages payable. Most companies break it out separately, but for accounting classes, I think you just play it safe. The difference between salary and wages: salary is a set amount, no overtime, and wages, you get paid by the hour. All right, so here's the last one, and this is interest. So remember the journal entry: interest expense, debit, interest payable, credit. And I demonstrated this on the exam. So Emerald City signed a 3-month note. And I want to make a point here that it doesn't matter how long the note is. Interest is always calculated annually. You always take that interest rate annually, and then you prorate it over the months. So $5,000, the note requires Emerald City to pay interest at an annual rate of 12%. So 5,000 times 12% is going to be $600, but it's only 1 month has gone by, so they need to recognize the interest that they owe of $50. All right. All right. And then if you were to have tracked this in your course pack and booked all these entries, you would end up with an adjusted trial balance. Okay. All right. And then from there, you would create your final financial statements. We created financial statements in the PowerPoint discussions in chapter 3, but they weren't final because we hadn't made the adjustments. So income statement, statement of retained earnings, balance sheet. All right. So we're running out of time to do closing entries, but essentially we get rid of the purpose of the closing journal entries is to get rid of all the revenue and expense accounts and the dividend account. So if we're going to close out dividends, we're going to end up crediting it to get it to go to 0. If we're going to close out service revenue, we're going to debit it to make it go to 0. And then all these expense accounts, we have to create a journal entry to individually credit each of these accounts to make them go to 0. All right. And there are 4 closing journal entries. So we are not going to hit that today, but you can watch that on my PowerPoint slide. Okay. All right. So I think that's it. So please come next week and we'll do some drill on chapter 4, but I also want to do a little bit of drill on chapter 5. Chapter 5 is, it's got a lot of material in it. Chapter 5 is where we start to sell actual products. So we don't just make that simple journal entry, debit accounts receivable, credit service revenue. We are going to say debit accounts receivable, credit sales revenue to indicate it's a product. Then we have to do a second journal entry to debit cost of goods sold and credit inventory. So that's more representative of what we see in a retail environment. All right. Does anybody have any last questions for me? And what else? Oh, I hope to see you this week for conferences. All right. All right, I'm going to say goodbye. I'm going to stop recording